Have you ever wondered why traditional investment methods seem to work for some, but not for others? It's a question that's puzzled many. The conventional wisdom suggests that investing in well-established blue-chip companies and diversifying your portfolio across different asset classes is the safest route to steady returns. It's a method that's been tried and tested over decades, and it's been accepted as the golden rule of investing. Yet, as many of us have experienced, this approach doesn't always pan out as expected. Despite the careful selection of stocks and thoughtful diversification, we've all seen those disappointing returns, or even worse, losses. It's a paradox that leaves many scratching their heads. If these traditional methods are so reliable, then why do they sometimes fail us? So, if traditional methods aren't foolproof, could there be another way to invest that might yield better results? Let's delve deeper into this conundrum. Before we continue, if you like this video, please remember to share it with your friends, hit the like button, subscribe to the channel, and hit the bell for notifications. Meet an alternative approach to investing. Contrarian investing. Often we're told to follow the crowd, especially when it comes to investing. But what if I told you there's a different path? One less trodden. A path where you deliberately go against the grain and choose to invest in assets that are not popular among other investors. Welcome to the world of contrarian investing. Contrarian investing is all about being bold, being different. It's about choosing to invest in stocks, bonds, or other assets that are currently out of favor in the market. It's about looking for diamonds in the rough, potentially undervalued investments that others might be overlooking. This approach isn't about being contrary for the sake of it, but rather about seeking opportunities where others see none. Imagine a seesaw. On one side you have the popular investments, the ones that everyone is talking about and piling into. These are the investments that are in favor. On the other side you have the investments that are out of favor, the ones that are overlooked, ignored, or even despised by the majority. As a contrarian investor, you would be on the out of favor side of the seesaw. The idea behind contrarian investing is that market sentiment can often swing too far in one direction, causing overreactions. This could lead to popular assets being overpriced and unpopular assets being underpriced. By going against the grain and investing in these unpopular assets, contrarian investors hope to buy low and sell high, thereby achieving potentially high returns. However, it's important to remember that contrarian investing isn't for everyone. It requires a deep understanding of the market, a high tolerance for risk, and the patience to wait for the market to recognize the value of the unpopular assets you've invested in. So, in essence, contrarian investing is about daring to be different, with the potential for high rewards. It's about having the courage to step away from the crowd and make your own investment decisions, based on your own research and judgment, and who knows, you might just find that the road less traveled is paved with gold. Now let's delve into the key differences between contrarian and traditional investing. Imagine the investing world as a marketplace. Traditional investors move with the crowd, buying when everyone else is buying and selling when everyone else is selling. They base their decisions on popular sentiment and follow the market trends. It's like going shopping when the mall is bustling with customers. You're likely to find good deals, but the really great finds, they might already be gone. Contrarian investors, on the other hand, march to the beat of their own drum. They zig when others zag. They buy when everyone else is selling, and sell when everyone else is buying. It's like going shopping when the mall is practically empty. You might find items that no one else noticed, hidden gems that offer great value. But there's also a chance that you might end up with something nobody else wanted for a good reason. The potential for returns can be higher with contrarian investing. When everyone is selling out of fear, contrarian investors can scoop up undervalued stocks and reap the rewards when the market corrects itself. But this approach comes with its own set of risks. What if the market doesn't bounce back? What if the stock was undervalued for a valid reason? Contrarian investing requires a keen understanding of the market and a strong stomach for risk. Traditional investing, while not as thrilling, offers its own advantages. It's more predictable. You're riding the market waves, not trying to swim against them. Your returns might not be as high, but your losses are likely to be less severe. Traditional investing is like a steady jog, while contrarian investing is more like a sprint. Both can get you to the finish line, but they require different levels of effort and risk tolerance. Therefore, the choice between contrarian and traditional investing boils down to a trade-off between potential returns and risk. As we wrap up, let's recap the key points we've discussed. We started off by exploring the intriguing paradox of investing, where the most popular choice isn't always the most profitable one. This sets the stage for contrarian investing, a strategy that thrives on going against the grain of popular market sentiment. Diving deeper, we unveiled the essence of contrarian investing. It's not just about being different for the sake of it. Contrarian investors are critical thinkers who dare to question the crowd, scrutinizing market trends and digging for potential value where others may fear to tread. They are the ones who buy when the market is in a state of panic and sell when euphoria takes over. Then, we compared contrarian investing to traditional investing. Traditional investing, with its focus on stable, time-tested strategies and blue-chip stocks, can often be the safer route. It's like the reliable tortoise in the race, plodding along and delivering consistent, albeit sometimes slower, returns. On the other hand, contrarian investing, with its penchant for zigging when others zag, can yield high returns. It's the hare in the race, potentially sprinting ahead with impressive gains. But remember, the hare also carries a higher risk. The market is a fickle beast, and going against its tide can sometimes lead to substantial losses. However, neither strategy is inherently superior to the other. It all comes down to you, your financial goals, your risk tolerance, and your investment horizon. A young investor saving for retirement might be more inclined to take on the risks of contrarian investing, while a retiree might prefer the safety of traditional investing. In the end, the best investment strategy is one that aligns with your financial goals, risk tolerance, and investment horizon. Remember, every investment carries some level of risk, and it's essential to do your research before making any investment decisions. If you liked this video, please share it with your friends, hit the like button, subscribe to the channel, and hit the bell for notifications. Thanks for watching.